two stocks I'm buying in March of 2024. This is a video that I do every few months talking about stocks that I buy. I talked about it last in December. I talked about two stocks that I was buying in my portfolio. I'm going to do it again this March, and then maybe I do it again in another few months. The first stock that I'm buying in March is more of a quality company, mega cap stock, and I think it's offering a pretty decent return, and it's a pretty good risk reward setup. The second one is more of a smaller cap stock. It's trading at 10 times earnings, growing earnings per share 43%, and it has a backlog that could stretch up to 7 years with around 5% insider ownership. And these are the stocks that I love to buy. And I've been finding many of them in Canada and the United States, many other places, and they have contributed to my performance year to date, which I'm up around 27%. It's been an amazing year, but it was mainly because in 2023, all the money was going to the Magnificent Seven. And all the small caps that I was buying in micro caps, they were not doing anything. Even though they were growing earnings per share, fundamentals were getting better, these stocks were not moving up. And if you remember in December, I talked about the Russell 2000 and small caps potentially doing well in 2024. And this is what's been happening. These stocks have been getting massive inflows. And even though they've been getting inflows, just like this stock is still trading at 10 times earnings and growing earnings per share 43%. And I have many more of these stocks in my own investment group. If you're interested in joining, I'm going to share it today. I'm going to start with the first one, which is more of a boring stock. I talked about it recently and I did buy it. And this is mainly Pepsi stock. I put some of my cash position in Pepsi. I'd rather own Pepsi than own some cash. So it's more of a shorter term, tactical kind of investment. But it's not a bad long-term investment at all for dividend investors or for people that like a safe return, that low double-digit safe return with a quality company like Pepsi. Pepsi has a wide moat and is diversified, just not Coca-Cola. Coca-Cola is more in beverages, but over 59% is in convenient food, snacks, and chips, and many others. And then you have 41% of Pepsi, which is in the Pepsi brand, and they have all, Gatorade and all these kind of brands, which most of you are familiar with. And I really like Pepsi for that. The second reason I like Pepsi is because they have a lot of brands that are still growing amazingly well organically. But it's not mainly just organic growth. It's mainly around price increases. They do have some volume declines, just like Coke and Nestle. And a lot of these brands have been facing volume declines. Pepsi has been facing the same thing. But these companies have such pricing power that they can raise prices no matter what, which makes the earnings per share growth predictable. And this is why you could find a pretty predictable and safe return with a company like Pepsi. Like, I don't think people will stop buying Gatorade if the price went up 8 or 9% or 12%, or same thing with the Lay's chips or Mountain Dew and a lot of things that people buy. So this is why they have pricing power, and it's a very safe investment again. But for the first time in a while, which is not common, you're getting this stock pretty close to 20 times earnings. When I bought it, it was like 19.8 times earnings. But now it's sitting at 20 times earnings. The mean was around 24 times, and it traded as low as around 18 times. So the low was 18 times. You're getting it around 20 times, which is very close to the low. And this low was mainly in March 2020. I don't think we're going back over there. So if you look at this chart of the price to forward earnings, normalized earnings, it's looking very attractive on this chart alone. So you're buying it below the mean multiple, which means you're most likely going to potentially experience a multiple expansion back to 23 times. So this is an extra return, and you still have the predictable earnings per share growth, which is around 7 to 8%. I would bet 8% over the long term. This is what the company has been growing at. Sometimes it'll be over, sometimes it'll be under, but their own guidance is long term around, high single digit earnings per share growth, which I believe is around 8%. So you're getting the 8% per year, and I believe it's sustainable. Earnings per share growth. You're getting like a 3% dividend. You're getting a potential multiple expansion from 20 times to 23 times. So I would see around 12, 13, maybe maximum 14% annual return with a company like Pepsi, which is amazing because it's very hard to find. It's better than buying, if a dying company that's yielding 4 or 5%. You're buying growing company growing 8% with a 3% dividend that's growing rapidly for Pepsi, and you could also get a multiple expansion. So I see an amazing value proposition with Pepsi, and I just put some of my cash position in the stock, and I'm holding it for a while, and maybe I could sell it a little bit later. This is not a long-term investment for me. It's more of a place to park some cash, and I see this opportunity with Pepsi, and I think Pepsi will likely go up if the Magnificent Seven or the tech stocks or the S&P pulls back, I think it could be some kind of a safety stock. It could inverse the S&P. And I just like it in general. I like Pepsi, so I bought Pepsi in March, and I'm a shareholder. I might keep it for the long term. I don't know. Although my main target is around 18 to 20% annual with the things that I do. But I like Pepsi here. I think it's undervalued. The second one, which I'm sure most of you guys are waiting for, this is a company that is listed in Canada, but it's also available on OTC. And I use interactive brokers to buy these Canadian stocks. They have like the lowest commissions and stuff. I have a link in the pinned comments. And this is a company named Bird Construction, BDT stock or BDT.to for the Canadian one. The other one, I could put it on the screen for the OTC listings. I also have a German listing, I think, and a lot of different listings, but not in the United States. So Bird Construction has been on a massive rally. I bought it earlier in the month. It's already up 15%. And if you look at it year to date, it's up like 35% over the last year. The company is up around 110%. Now, this is a company most of you have never heard of, mainly because of YouTube, because most people on YouTube, they only talk about Nvidia, Google, Apple, and these companies are amazing companies. But you have these small stocks that are, just growing massively for 10 and 11 and 12 times earnings. I talked about them, decisive dividends up 40%. Mama's Creations, when I talked about it on YouTube, I'm up 200% on this investment. And you have all these companies that no one heard of, making massive move, but everyone is so focused on the Magnificent Seven. So this is why I'm trying to do these videos, to try to encourage people to try to, maybe with a smaller percentage of the portfolio, try to look into smaller cap, micro cap, multi-baggers. And this is what I do in my own group. I have large cap stocks and mid cap safe stocks, but I have a small percentage in these stocks, because if I'm right and things go well, they go up 10, 20, 30 times over the long term, I could make amazing returns. And this is what I'm doing. And Bird Construction, I think you could guess, it's a construction company. They operate in many different industries, in manufacturing, some things within mining, which is critical in Canada, and mining has been increasing in Canada recently to get critical metals in utilities, power, oil and gas, and which is most important one, is mainly around future energy. So solar, wind, they have a contract with the government to build some kind of a nuclear power plant and maintain it in a certain way, carbon capture devices and many different things, even bridges and rail. So they're pretty much everywhere. Bird Construction is more of an integrated company. They're more of a conglomerate. They have exposure to many different industries across Canada. And this is the performance of the company over the last quarter alone. Revenue is up 22% year on year. Gross profit is up 26% year on year. Adjusted earnings per share, is up 57% year on year. And if you look at the and over the last year, so 12 months, 61% growth earnings per share for this construction company. And if you look at the multiple, it's still trading at 10.5 times earnings. When I bought it, it was like 8.9 times earnings. And now it's 10.5 times earnings with a mean of 13 and with a high of 26 times. Now, how is this possible? You might believe there's a catch or something. Maybe the company has low return on capital. Not at all. Return on capital around 15, 16, 17, 18%. So very decent return on capital for this company, and it's growing around 61, 59%. Now you might ask, how is this possible? Well, if you look at the long-term chart of the company, it's not the best chart at all. The company has been flat for years and years and years, and it recently started going up mainly in late 2022. And this is because the company has been doing something wrong. They've been focused a lot on the cyclical industry. So, construction is cyclical, a lot of cyclical stuff, not doing the right thing, not focusing on higher margin stuff. And they just made an entire 360 in late 2021. They started taking the free cash flow instead of paying these dividends and doing all these things. They started doing acquisitions to grow free cash flow per share or earnings per share. And this is how the company has developed a backlog. And now they have a backlog. I think it's around 3.2 billion or 3.1 billion. And the entire market cap is like $1 billion Canadian. So it's around 3 times the market cap. And they have, pretty decent growth, and it kept growing every single quarter. Even the last quarter, the backlog did grow, which means that construction is still going in Canada. But now they are focusing more on recurring revenue contracts. Over 1.1 billion is recurring revenues, which means contracts to, for example, maintain certain utilities or maintain certain buildings within their electrical companies. They have electrical companies and many different things, plumbing companies, and they are more recurring revenue contracts to maintain it over the very long term, over the next 5, 6, 7 years. And you can see it, MSAs and other multi-year recurring contract they have a predictable revenue stream over the next 1 to 7 years. So this is 1.1 billion from the 1 year to 7 years. It's most likely 7 years. So this is what they started to focus on. And the second thing is why they're experiencing massive growth. And if you look at the interest rates in Canada, they are at a record high over the last 10 or 15 years. So even with interest rates being so high, if you look at housing starts, housing construction is still very, very strong. You look at this kind of construction, it's still very, very strong. A lot of immigrants are coming into Canada. Population is growing. They need more stuff. They have old infrastructure. They have a housing problem. So this is why I'm invested in these construction stocks, many different companies within Canada around construction. And this is one of the reasons why this company has been and will likely continue to experience massive earnings and revenue growth. The first one is mainly around the net zero transition requirement. So they have around some kind of a net zero transition to 2050 in Canada, and the expected budget is around 125 to 140 billion annually through 2050. And Bird Construction is getting a piece of it because they also operate in future energy transition, carbon capture devices, solar, wind, nuclear, and all these kind of things. So this has been a tailwind for them. Something else is to double the electricity supply. They have more people, more housing stuff. They need to double the electricity supply. They need more electricians, and they need a lot of different things to do. And Bird Construction does have a lot of specialties within this area, and this has been happening. The other one is mainly infrastructure deficit. It's around between 110 to 270 billion. Public transportation, and mainly around the nuclear opportunities. They've been winning key nuclear contracts with many local state and governments. Around $40 billion in total investment is projected to go into the nuclear energy to power Canada and many different things. So they have a lot of different tailwinds of why this company is not going to be as cyclical as it used to be. This is the main risk, is the cyclicality. Construction is cyclical. But what I'm doing is I'm just keep paying attention to the backlog. And the backlog have been growing, and it keeps growing every single quarter. And they do have a lot of different specialties that a lot of other companies don't have. And this is the reason why they have this backlog, is because they can do a lot of things that other companies can't do, and they don't have the people, they don't have the experience to do it. And they have a labor shortage in Canada too. So this is another reason why. So the main risk is the cyclicality, but there's way too many tailwinds, and you have way higher interest rates. If interest rates come down, construction is going to boost even more and more. And they have this backlog that I'm paying attention to if it's growing and declining. The second catch with the company, you could say a catch, is lower net income margins. They got as low as 1.9% in 2022. They rebounded to 2.6%. Now they expect to be around 3% in 2024. And this is because they started focusing on higher margin recurring revenue contracts, recurring revenue opportunities. And this is what's changing the face of the company. And they keep doing the acquisitions. And if you listen to the CEOs, they're very optimistic about 2024 and beyond. They're going to continue doing what they've been doing. And it has been working. And I think it will continue working. In terms of earnings per share growth, they grew 43% in total EPS gap for 2023. 2024 is expected to be 32%, and 2025 is expected to be around 19%. Now, for me, I don't need them to grow 32% in 2024. I don't need that. Even if they grow 15%, 16%, 20%, or if just grow 15% annual for the next 5 or 10 years, this is more than enough for me if I'm paying 10 times earnings for this company with this kind of management, with this kind of business model, and all the recurring revenue stuff. So I think the company is still extremely undervalued. I would potentially see around a 20% plus annual return with something like Bird Construction. And I do own the company, of course. It's sitting at $756 million US dollar market cap. Now, for me personally, if they keep growing revenues, they keep doing acquisitions, they keep expanding the business, I don't see why this company cannot be a $7.5 or $8 billion construction company within the next, 10 or 15 years. So for me, it's more of a longer term investment. It could be a potential 10 bagger, and I have many of these stocks in my own group, much smaller stocks, 50, 100, 150 million market cap, if you're interested in joining. And this was not financial advice, just my opinion on these two stocks, Pepsi and Bird Construction. Thank you very much for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.